Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about a much awaited preliminary views document from GASB. Today we're going to talk about their revenue and expense recognition model. Now, they have been working on this for quite some time, and this is a preliminary views. It's taking the ITC, the invitation to comment that was issued earlier, and building on it. Unfortunately, they don't go with any of the three original models that they had proposed. Instead, they make a new model in this preliminary view. Now, the preliminary views document was issued to the public on June 30th, and it is, you can see here, comments due February 26th of 2021. So they are leaving a considerable amount of time for us to be able to comment. They really are looking for feedback on this model, and I think it is because of the large change and the material differences here. It's going to be something that most entities are going to want to take a look at and just make sure that it's operable. It's not a complete model. Again, it is a preliminary views document. There is more to come, but once they go down this path, they're going down this path. The next step would be an exposure draft and then a final standard. So a little bit about this, it is a comprehensive model. It covers both revenues and expenses. So both IFRS and US GAAP as issued by the FASB have gone down this path already, right? So we already have topic 606 by the FASB for revenue recognition. However, both IFRS and FASB only addressed revenue recognition. GASB took on a much loftier project by addressing both the revenue and the expense model at the same time. So this is a very large undertaking, and it is really interwoven. So as we look at it. So really trying to build on already some of these changes that are out there that we have seen in how we consider the revenue models, and what we see coming from FASB and IFRS clearly have a material impact on the outcome of this proposal. So when we look at the proposal, there's really a three-step process. We now are calling it categorization, and they are now using the term category. It was classification. So we were talking about the exchange, non-exchange model, or the PO, no PO model, or the alternate model that they had originally proposed in the ITC. And basically, when you look at a transaction, you have to put it into a category. And they're going to use neutral categories now. They're going to use category A and category B. So as opposed to the exchange, non-exchange, or PO, no PO model that they had proposed, they went with a neutral classification because they take some of a little bit of everything here from the ITC, and they don't use any one model that they had originally proposed. They make some significant changes in this preliminary views document. Once we know what category we're in, then we have to decide when an item should be recognized. So recognition is about timing, right? So if you think about when something would be recognized, and then once it is recognized, we need to be able to measure it and determine the amount that's going to be reported. They are going to build on this. The original ITC did not address measurement at all. So this does develop a little bit more in that measurement category. Now, not everything is in the scope of this standard. In fact, scope has been one of the big topics of conversation here. So they have gone back and forth. There's been some pretty big changes from even the ITC. So right now, the major items that are being excluded from this preliminary views documents: capital assets and inventory transactions, financial instruments, and then post-employment benefits and compensated absences. So they are trying to figure out, they want this to be comprehensive. They want it to really look at all types of transactions. And so as a result, they tried to minimize the items that are being excluded. So when we think about categorization, right, the original ITC talked about exchange, non-exchange, really just trying to update the existing model. We had an exchange model and we had a non-exchange model. However, that model was very flawed because when you're trying to decide whether something is exchange, right, riding the subway is heavily subsidized, right? You're not actually paying the value that you would have to pay if you were going to actually cover the cost of riding on the subway. And so there are a lot of criticisms of that model. And so when they proposed the PO, no PO model, or performance obligation, no performance obligation model in the ITC, they also found some issues because some of the verbiage that we would borrow then from the FASB standards doesn't really work well in a GASB environment, in a governmental environment. So as a result, they came up with this neutral classification. And again, it applies to revenues and expenses. And so we start off with the sequential assessment. So we basically walk our way through all 4 sets of questions. So first off, is there a binding arrangement? Now, FASB and IFRS call this a contract. GASB is careful not to use that terminology and instead focus on a binding arrangement. So it includes grant agreements, it includes a little bit of a broader perspective here. Once they've evaluated that, if it's not binding arrangement, then it's not in the scope of the standard. Then they would evaluate, have the parties approved the terms and conditions? So thinking about the agreement, is there a meeting of the minds? Is there approval of this, very similar to the FASB standard? Do parties have substantive rights and obligations? And so when we look at this, do I give and get, or what is this process going to look like? So do we have rights and obligations? And then are the rights and obligations interdependent? And so we walk through this series of questions. If we answered no, there's not a binding arrangement, then as I mentioned, we're not in the scope of the standard. If we say yes in terms of all 4 questions, then we would call this a category A, or a something for something that also has a performance obligation, borrowing that terminology from FASB. Now, it's not an exact definition, right? So again, FASB uses this concept of a contract, whereas we're going to talk about a binding arrangement, but that concept of being a distinct good or service is going to carry over from those FASB standards. If we don't say yes to all 4, then we would consider it to be what we call a category B type of transaction. And here we're going to see some reminiscence of the old non-exchange, but not exactly. So when we look at category A, when do we recognize it? So we've categorized it into A and B. When we're looking at category A, the question is, when would we have recognition? And it would be based on the satisfaction of a performance obligation. So very similar to the terminology that we see for FASB, you would have to identify your distinct goods and services, and then you would recognize when you transfer control of those goods or services and you satisfy that performance obligation, whether that's over time or point in time. Very similar with nuanced differences to our FASB standard. So for those of you who speak 2 languages, I always say FASB GAAP and GASB GAAP are speaking 2 totally different languages. But if you speak both languages, there's somewhat of a little bit of a benefit here because a lot of this does resemble a little bit of topic 606. So you're going to feel a little bit of 606 as you go through this in terms of that transfer of control and the satisfaction of a performance obligation. If you're not in category A, we're going to be in category B. And here, you'll see here, we have that derived and imposed revenue, sort of a reminiscent of the old non-exchange statement 33 transactions. But you'll notice that the next 2, or actually 3, because general aid and shared revenue are actually different. They're just lumped together here. In that scenario, are different. In the first 2, derived revenue and imposed revenue are revenue-only items. Contractual binding arrangements and general aid and shared revenue are going to have both. So a little bit of a nuance here. So in terms of derived revenues, this would be a great example like sales tax. When the underlying transaction occurs, right, we would recognize that revenue. So when there's the sale, then the revenue for the sales tax would be recognized. In an imposed transaction, so property taxes, we would look at the imposition date or the date of omission or commission, right? So when we think about some of the imposed transactions. If it is a contractual binding arrangement where there's an agreement, it didn't meet all 4 requirements to be a category A, but there is a contractual binding agreement, then we would have to look at the terms and conditions, right? We'd have to actually read the contract and we would recognize based on those terms and conditions. And then when we look at general aid to government and shared revenue, it would be the existence of the provider government appropriation. So in this scenario, they're going to appropriate the money for the general aid or for the shared revenue. The commencement of the appropriation period, we're in the period for that, and the provider government has intent to provide it. So in those scenarios, at that point, we would recognize that revenue. Now, the ITC, as I mentioned earlier, did not really address measurement. So it was not included. They just included classification and then recognition. Now we're going to have our categorization and our recognition, and it adds on measurement. And so the way they look at this is that we're going to look at our assets and liabilities, and that's going to help us identify and measure the items. And revenues and expenses are going to be measured based on those related assets or liabilities. Now, when we're doing those assets and liabilities, we do have to look at the probability of having to refund anything and the probability of uncollectability. So if we have a receivable, but we don't believe we're going to collect it, we do have to adjust appropriately and recognize, for example, an allowance for doubtful accounts. Now, they're not done. As I said, this is part of a big project. So last week on the blog, we talked about the conceptual statement that they had issued, the recognition of elements of financial statements. That is part of a bigger project, which will end up in a proposed statement for the financial reporting model. So while they're working on revenue recognition, they also have to be cognizant of what's going on in the larger program here for the financial reporting model. And so that's like GASB 34 2.0, I like to call it. So they're considering that as they work on this, and they don't want to end up with conflicting guidance between the two. So the two groups are really being careful, and there's a lot of discussion about how one influences the other. In addition, they don't address everything. Obviously, this is a next step. So we're past an ITC, we're into a PV. The exposure draft will even further continue addressing things like binding arrangement modification. If you're familiar with the FASB gap in this, contract modification is a very difficult area. You have to determine whether the modification creates a separate contract. And then if it doesn't create a separate contract, is it going to be prospective or retrospective in terms of the treatment? It also has to address binding arrangement combinations, very similar to FASB if you have two things that happen at or near the same time, right? We see that guidance in the GASB 87 for leases, which is carried over from the FASB standard. In this, we also have to address that, as well as transactions partially in scope, right? So sometimes you have some that is in scope and some that's not. For recognition, they're not finished with this. They still need to address overtime, which we used to call under FASB percentage completion. It's not exactly the same as percentage completion. And so how do we estimate progress? So when we think about percentage completion, it was estimated cost to date or cost to date over estimated cost to complete. That's not how FASB does it. We have to look at an input or an output method for them. So very similar. GASB has to consider what they want to do in terms of the estimation of progress. And then they also need to consider series guidance with relation to these recognition. So there's guidance in FASB standard on if it's a series of performance obligations. They also have to look at measurement. Under the FASB standard, we call this step 4. Step 3, how do we determine the transaction price? And then step 4, how do we allocate that transaction amount to the ultimate performance obligation? That has not yet been addressed in the standard, but is something that they will develop before we issue an exposure draft. But again, we have more years before that happens. Again, this is not even due until 2021. They would then have to do this and then issue an exposure draft in the future. So again, this has a pretty long lifespan. One of those questions that I typically get is when this is going to be issued. Again, we have a couple of years before we get to a final standard here. So no rush, but definitely take a look. I'm covering about 100-page of materials in under 15 minutes. So you don't want to just look at the cursory topics. You really do want to take a deep dive into what does this mean in practice. All right, so while that was high level, that's what we're going to cover today on the blog. Hopefully it's a nice little overview of what we have from GASB here. I'm kind of excited to see what we hear in this area. So I'm looking forward to being able to include this in some upcoming GASB updates and see what attendees are interested, whether they like it or they don't. I would love to hear from you. Do you like the new model? Do you think that the movement towards a similarity to the FASB and IFRS guidance is a positive thing? Do you like the Category A, Category B terminology? I would love to get some of your opinions. So definitely let us know what you're thinking. Other than that, it was great having you today on the blog, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.